Good morning, everybody. I hope you're doing well. Today we will be studying one of the foundation chapters, okay? That is sale of goods on approval or return basis. Okay. Now, before we go ahead and understand, first let's understand what exactly is sale. Sale means one party selling his goods to an other party. The first party will be called as seller and the second party will be called as buyer. Okay, so you have two parties. One is the buyer and the seller. Buyer or the customer, also consumer, anything. Now, so when one party sell goods to an other party, that transaction is called as sale. Sale is the final effect of sale can be given when either of the three conditions are satisfied. The first condition is the buyer has accepted the transaction. So in that case, it is sale is confirmed. Second, the buyer has done an act adopting the transaction. Means if it is a if it is a consumable product, he has consumed it, then sale has happened. Or if it is a cloth, he has used it or he has worn it, then in that case we confirm that sale has happened. So he doesn't act adopting the transaction. Or the third one, the time period which was fixed between seller and the buyer has expired. So in that case also we will assume that the sale has happened. If the time which is there's no time fixed, then we will take a reasonable amount of time. Okay. Now, what exactly is sale of goods on approval basis means? Let's say for example, there is a wholesaler or and he sells the goods to retailer, correct? So the chain will be manufacturer to wholesaler, wholesaler to retailer, and retailer to customer. Now let's take this transaction between the wholesaler and retailer. The wholesaler and the wholesaler will normally get the goods from the manufacturer and keep sending it to the retailer. But when it is a new product in the market, the retailer may be in a two minds if he wants to take that product from the wholesaler or not, because he is not sure how the market will respond. So if the market responds bad, then the thing will be on his head and it will be an unnecessary loss. So when it's a new product in the market, he may not want to actually buy it, or he may be in two minds. So in that case, to push the sales, what the wholesaler will do is the wholesaler tells the retailer, let's do one thing. You take the products and keep it in your premises. If you are able to sell it further, then we accept this. Then our transaction will be sale or purchase. But if you're not able to sell within the specified period of time, then you do one thing, you return the goods back to me. In that case, this transaction is called as sale of goods on approval basis. You are selling the goods to the retailer on approval. Means if the goods are not further sold, or if the time period has expired and the retailer does not want to keep this goods, he can send it back to the wholesaler. That is called as sale of goods on approval basis. Let's take an example. There is a new product in the market. So the wholesaler sends to the retailer. I'll just take some small figures. He sells 10, let's take jeans, it will be easy. 10 jeans at rupees 200 per jeans to the retailer. So this transaction happens on 1st of September. So in that date, in the books of wholesaler, what entry we will pass? The entry will be debtors account debit. Mind you, it will not be cash sales. If it was cash sales, then this entire thing would not come, right? So debtors account debit to sales account. Okay, so that is 2000 rupees. Okay. The wholesaler gave the retailer about 2 months of time to either accept or reject the goods. So we have time till 1/11. On 1/11, there are two possibilities. Either the goods are returned back, that is rejected, or the goods are approved. Okay. If the goods are rejected, can I say I've already passed an entry for sale of goods? So what we will do? We will reverse. So the journal entry will be sale account debit to debtors account 2000. Okay, but on if on 111 if the goods are approved, then can I say we've already passed the sale entry? So in that case I will not pass any entry, so there will be no entry. Okay, now if he approves, there might be another possibility that he approves at a lower price. That is, he says I will buy only at 180 rupees per jeans. So in that case, can I say I have passed the sale entry to give effect at 200 rupees per jeans? So can I say that 20 rupees per jeans for 10 jeans, that is 200 rupees, will, to that extent I should reverse my sale? So my journal entry will be sale account debit to debtors account. Okay, now sometimes it is possible that he may accept at a higher price. If he accepts at a higher price, let's say 210 per jeans, then in that case can I say that 10 rupees per jeans I will get extra, that is for 10 jeans, which is 100 rupees. So in that case, to that extent I have to pass my effect. So journal entry will be debtors account debit to sales account. Okay, so this is how we will do. Now this is the transaction. Now let's include the last pointer in this case, that is, what if the goods are sent on 1st February and the retailer has time up to 1st May. Between these two dates, there is a magical date that comes. That is our 31st March. So if the year end comes in between these transactions, then how to deal with it? Okay. Now, 1st February, when the goods are sent, same entry you will pass. That is debtors account debit to sales account 2000. Okay. Now, on 31st March, let's say no information is received. On 31st March, no information is received. Now, one minute. Can I say, has the time limit expired? No. Has the has the retailer given approval? No. Has the retailer rejected? No. Means nothing has happened. There is absolutely no information available. In that case, what to do? In that case, you will pass two entries. Okay, what are they? First entry. Now, for the year, I have already passed the sale, but has the sale been approved? No. So at the year end, to give a true and fair view, we will reverse the entry. That is sale account debit to debtors account. Okay, so this will be 2000. And second, so my sale has been reversed, effect nullified. Now second, my stock is lying with the customer, correct? It is my stock, I should record in my books. Hence my journal entry will be inventory with customer account debit to trading account. Okay, now this entry, can I say I should pass? Obviously, when you're accounting for your inventory, you will not account at 2000 rupees. You should record it at cost price. Ma'am, how to arrive at cost price? I will come back in a while. But before we will finish this thing, how to arrive at this? I'll just come back in a while. Now, on 1st May, there are two options available. Either he can accept or he can reject. If he accepts the goods, then can I say first sale happened, you reverse the sale, Now he is accepting. So what we will do, we will actually pass the sale entry. So that is debtors account debit to sale account at 2000. If he rejects, then can I say sale entry you passed, you reverse the sale entry and goods have come back. So we will not pass any entry. Okay. See, whenever the goods are coming in, it will be recorded in the inventory. Okay. So here in accounts, we will not pass any entry. Now, coming back to your cost price. How to calculate cost price? They have given you in the question selling price and they will give you a profit percentage. So you know the formula, cost price plus profit will give you selling price. Okay. So now you have to understand. Now here you will have to go reverse. Cost price minus profit will give you selling price. Now sometimes this profit percentage will be given on cost price. So you cannot directly multiply. You will have to find the number. So how we do it? How do we do it? If they say profit is half on cost, then it will be 1/3 on selling price. If they say it is 1/3 on selling price, then it will be 1/4 on cost price. Okay. So this effect will always be there. Sorry. 1/4 on cost price, then it will be 1/5 selling price. So one more on selling price always. If you see one more, it is one more. If it is 1/4 on cost price, then it will be 1/5 on selling price. It will always be one more. So you have to convert it into percentage. So 1/4 is 25% and 1/5 is 20%. Okay. So what you will do, if the cost price is 2000, so you will do minus 25% in this case, and in the next case you will do minus 20% to arrive at the cost price. Am I clear till here? After this, now whatever we studied till now, this effect is done when the goods are sent casually. Casually means very less goods are sent. So in that case, we record the entire transaction as ordinary sales. Means if the goods or these transactions are done casually, means very less transaction, then we record it as ordinary sales. Means the thing that I have just taught you right now. But if they are sent frequently, then we prepare a column, a multi-column in your memorandum book. Now, memorandum in memorandum word in accounts means in the rough books we prepare a column, a book where we keep certain columns. We write what are the goods sent, what are the goods returned, what are the goods approved, and what are the balance goods. So once the goods are approved, you pass entry in the fair books, how we did just now, debtors to sales. And at the year end, whatever is the balance, we pass two entries. That will be your reversal of the sale and your inventory with the customer to trading account. These two entries we will give at the year end. Okay, so this is in case of frequently. If the goods are sent numerously means lots of transactions, then what do? We in the memorandum books we prepare 2 day books. That is one. In the memorandum books we prepare 2 day books. That is sale or return day book and sale or return ledger. Okay, so these are prepared in the memorandum books. Once the goods are approved, then it will be passed the sale entry, and again on the year end, whatever is the balance, we pass to effect. Now, for your examination point of view, this is very frequently asked. This is asked 2 in 10 times. So this is other 8 in 10 times. This they have not asked as of now. They may ask. Okay. So casually, you treat it as ordinary sales. On the date of sending, you will record debtors to sale. On the date of acceptance, you will not do anything. If it is rejected, then you will reverse. If in the middle year end comes, then you will pass two accounting entries, that is your reversal of the sale, that is sales to debtors, and second one is inventory lying with customer to trading account. Am I clear? Chalo, wish you all the very best for exam. Study well. If you have any doubt, you can mention me the questions below. Bye.